Welcome to Talk Tickers, your go-to source for breaking down the most important earnings calls.
Glad to be here.
Today we're diving into the Hershey Company's second quarter 2025 results. They dropped pre-market on July 30th.
And it was, well, a really interesting quarter. Definitely a tale of two halves, you could say.
Exactly. Some analysts are even calling it a candy bar K-shape, a real split. On one side, you had revenue just soaring, really strong top line, but then profitability, that faced some pretty serious headwinds.
Big time. So we're going to unpack all these numbers, look at what management had to say, their strategies.
And figure out what it all means for investors, maybe even for, your next grocery run.
Right, because this isn't just about spreadsheets. It's about how a huge brand like Hershey navigates, well, some really intense market pressures.
And how they're trying to pivot strategically at the same time. It's a fascinating story unfolding.
It really is.
So let's kick off with the headline number, just a quick snapshot for you. Hershey delivered a genuinely solid quarter based on their adjusted figures. Much better than expected.
Yeah, the adjusted non-GAAP EPS came in at $1.21.
Which was way above the consensus estimate of just $0.99, a 22-cent beat there. Pretty significant upside.
Very strong.
Yeah.
And it wasn't just the earnings. Revenue also topped expectations.
Right, $2.615 billion versus the $2.524 billion consensus.
And what's really striking there is the underlying growth. Organic constant currency revenue was up 26% year over year.
26%, that's huge. Shows real brand power, doesn't it?
Absolutely. But here's where that K-shape analogy really hits home.
Yeah.
While those adjusted numbers were sparkling, the GAAP EPS, that's the one following all the standard accounting rules.
Okay.
That saw a really sharp decline, down 65% year over year to only the $1.31.
Wow, 65%. That's a big drop. Yet the initial market reaction, it was positive, right? The stock jumped.
It did, yeah. Saw a healthy bump right after the release.
So it makes you wonder, why did investors seem to just shrug off that massive GAAP decline initially?
Well, I think that initial applause was really for the pricing power they showed and that big revenue beat. It signaled strong demand.
Okay, focusing on the top line strength.
Exactly. But, as the details about that tariff impact, the thing driving down the GAAP number, as that became clearer, we did see some of that initial pop fade away later on. It highlights that tension, that divergence.
Got it. So let's go deeper then, beyond the headlines. Let's get into the financial and operational stuff, because that's where you really see this K-shape play out.
Sounds good. Where should we start? Segments?
Yeah, let's do segments. North America confectionery sales, they surged, up 32%.
32%. Just incredible demand domestically for their chocolate and candy.
And their salty snacks segment, that also showed pretty solid growth, up 8.8%.
But interestingly, international sales, while they were up 4.4%, they actually missed expectations.
Oh, really? Why was that?
Kind of a triple whammy, it seems. Unfavorable currency exchange rates, softer growth overall in Mexico's candy market, and less demand for exports.
So North America is booming, but internationally, it's a bit more challenging.
Exactly. A different picture overseas.
Though they did call out Reese's specifically, right? Said international growth was almost 8% in the first half.
They did, yeah. And they plan to accelerate that in the second half.
Still, it makes you wonder how quickly they can get that international side firing on all cylinders like North America. What's holding back the global Reese's takeover?
Fair question. And speaking of challenges, that brings us right to the gross margin pressure.
Right. This is a big factor. Adjusted gross margin down 510 basis points.
Yeah, that's 5.1 percentage points, down to 38.1% in Q2.
That's a significant hit.
And the main reasons were commodity inflation, specifically cocoa, and $2 million in extra tariff costs.
Precisely. That's the direct hit from those input cost shocks. That's what's pulling down the bottom half of that K.
Okay, that's substantial. But management, they seemed pretty confident about a recovery plan. Oh, very confident. And quite aggressive, actually. They're aiming for a big adjusted gross margin recovery, over 500 basis points, just in the second half of this year.
Wow. Okay, how?
Through strategic pricing actions and productivity gains. And they're not stopping there. They're targeting another 500-plus basis points of recovery in 2026.
So a multi-year plan to get margins back really shows how sensitive they are to these commodity swings.
It absolutely does. And, their approach to the cocoa situation is pretty interesting. Prices are still incredibly volatile, really high, around $7,000 per metric ton, even with a bit of a pullback recently.
Still very elevated, though.
Yeah. And they expect that cocoa cost inflation to continue right into 2026. But, and this is crucial, they highlighted their hedging strategy.
Ah, okay. Hedging.
Right. They locked in their 2025 cocoa prices way below the current market rates. That gives them a really important buffer.
That sounds like smart planning, managing a huge variable cost like that.
Definitely proactive. And they're not just relying on hedging. They also announced a new price increase across their entire U.S. confection portfolio.
The whole portfolio, that's what, 80% of their sales?
Yep, about 80%. And they expect this move to add something like 16 points of pricing contribution.
16 points. That's bold. It'll be fascinating to see how consumers react, paying more for their Kisses or Reese's cups.
It's a big test of elasticity, for sure. And that price hike is really critical, especially given the tariff hit they're expecting.
How much is that supposed to be?
Between $170 and $180 million for the full fiscal year 2025.
Ooh, that's a lot.
It is. Though, interestingly, management sounded, optimistic about maybe getting some cocoa tariff exemptions. That could be a big swing factor.
Okay, someone to watch.
And they explicitly said, if it weren't for these tariffs, they actually would have raised their adjusted EPS guidance, not lowered it.
Wow. Okay, that really puts the tariff impact into perspective. So beyond pricing and hedging, productivity and innovation were also big themes, right? Ways they're fighting back against these costs?
Yeah, absolutely. CEO Michele Buck really emphasized, balanced growth, tackling cocoa costs through better productivity, using technology for efficiency, and those price actions we just talked about.
Did they put any numbers on the productivity side?
They did. They actually boosted the savings target for their big automation program, the AAAT, they call it.
Okay.
Raised it from $350 million to $400 million by 2026. And they expect to get $150 million of that this year alone.
$150 million this year, that's substantial. Shows a real focus on internal efficiency.
For sure. But it's not just about cutting costs, right? Innovation seems like a genuinely bright spot.
Yeah, tell me about that.
Well, those seasonal Reese's items apparently drove that big confectionery surge, but they've got more coming. New stuff like a thin center Reese's bar.
Interesting.
Shaquille O'Neal's Shakalicious XL gummies, and that Reese's Oreo cup collaboration everyone's talking about.
The Reese's Oreo cup. Okay, that sounds like a winner.
Right. It's not just random new stuff. It's strategic. Expanding how and when people eat their products, reaching new groups.
And it's not just candy, right? They mentioned snacks, too.
Yeah, SkinnyPop grew thanks to new packaging and some interesting new flavors like avocado and lime, and even a Harry Potter butterbeer flavor.
Oh, they're popcorn. Okay.
And Dots Pretzels, the brand they bought. Apparently it's doing really well. Up 13% in retail sales.
So connecting the dots here, they're protecting their R&D spending, keeping that innovation pipeline full, even while managing costs elsewhere.
Exactly. It seems crucial for their long-term plan to kind of out-innovate and out-price these commodity shocks. It reinforces that shift they're making from just a stable candy company to more of a premium treat maker.
Makes sense. And speaking of the long-term and strategy, there was a huge piece of news, the leadership change.
Yeah, that was big. Kirk Tanner, he's coming in as the new CEO effective August 18th. He's got a background at Wendy's and PepsiCo.
Right, replacing Michele Buck, who's moving to an advisory role. That's a significant shift at the helm.
It really is. Yeah. And Tanner's background, beverages, fast food, it could signal a different focus.
Yeah.
Maybe more emphasis on certain sales channels or even M&A in the wider snack world.
Yeah, you have to wonder what strategic changes a new CEO, especially one from outside the core confectionery space, might bring. How will he tackle that K-shape problem?
That's the multi-million-dollar question, isn't it?
Okay, let's pivot now to the outlook for the full year and the sort of bigger strategic picture.
Right.
So for fiscal year 2025, they reaffirmed their net sales growth target greater than or equal to 2%. So the top line is still expected to grow.
Right. But, and this is the other side of that K again, the adjusted EPS guidance, that got revised downwards.
So much.
They're now expecting a decline of 36% to 38% year over year. That's wider than the mid-30s decline they guided to previously.
So a bigger drop expected now.
Yeah. And GAAP EPS is seen down a whopping 50%. Again, this reflects higher taxes and, crucially, that current tariff policy. Like we said, without tariffs, they implied they'd be raising guidance.
So tariffs are really the story on the bottom line guidance cut.
Pretty much, yeah. They do expect things to accelerate a bit in the second half, with maybe 2% to 4% growth driven by innovation, merchandising, Halloween, Christmas.
Big candy seasons.
Exactly. But interestingly, Q3 specifically is actually expected to see adjusted EPS decline sequentially from Q2.
Oh, why is that? Just timing.
It's a tough mix of factors hitting in Q3. Those higher cocoa costs really start biting, tariff expenses ramp up, they're still investing heavily in their brands, plus higher interest costs and tax rates.
Okay, so Q3 looks like a particularly challenging quarter before maybe a better Q4.
Seems that way. It paints a picture of, a challenging back half, even with all the actions they're taking.
So the whole strategic narrative seems to circle back to that candy bar K-shape, doesn't it? Strong revenue, but profits hit hard by those external factors, mainly cocoa and tariffs.
That's the core tension. And management's story is that they're pivoting, moving from being seen as just a defensive staple food company to being a more nimble premium treat maker that can pass higher costs on to consumers eventually.
And they're protecting R&D while cutting SG&A elsewhere to keep that innovation engine running.
Right. The strategic balancing act.
Right.
And looking ahead, there's a lot for investors to watch. They've got an investor day in September. Expect more details on margins then.
Okay.
Then there's a potential cocoa tariff decision in October. Halloween sales data will give clues on demand.
Right, how well those price increases are sticking.
Exactly. And then Q3 results in November will show that pricing elasticity much more clearly. Lots of catalysts coming up.
And one more thing on strategy, capital allocation. They didn't buy back stock in Q2, right?
Correct. They specifically said they're prioritizing capital for acquisitions instead. They mentioned buying Fulfill North America and the pending deal for Lesser Evil, which should close later this year.
So focusing on growing the portfolio through M&A rather than buybacks right now.
Seems to be the focus, yeah. Expanding their snack offerings.
Okay, let's put this all in a bit of broader investor context now. How has the stock actually been doing?
Well, it's been a bit of a mixed bag. Over the last month, the stock was up nicely, about 11.7%. And over 3 months, even better, up 15.1%.
Okay, decent recent performance.
But if you zoom out to the last year, it's actually down 4%. Meanwhile, the S&P 500 gained about 14.5%, and even the Consumer Staples ETF, XLP, was up 4.6%. So lagging over the longer term.
Interesting. And leading up to this earnings call, there was some positive momentum.
There was, yeah. The stock had an 8-day winning streak, climbed 15%, and got price target bumps from Morgan Stanley and Stifel just before the results. Sentiment seemed to be improving.
So how did the analysts react overall after the call?
The sell side, the analysts who publish ratings, were kind of cautiously bullish. Edward Jones, for instance, kept a hold rating. They called the earnings beat the widest in 5 years, but they're still worried about that cocoa risk.
Understand.
Morgan Stanley and Stifel nudged their price targets a bit higher, suggesting some optimism that Hershey can navigate these challenges.
But what about the buy side? The actual fund managers?
That was more mixed. You had momentum funds jumping in, seeing that strong adjusted number beat and the demand ahead of the holidays.
Okay.
But then some quantitative funds, the ones driven more by algorithms and near-term earnings revisions, they apparently trimmed their positions after that widened EPS guidance cut.
Focusing on the tariff impact.
Exactly. And that's probably why the stock faded about 1.4% the day after the call. Shows that divergence again. The street liked the pricing power, but some investors got spooked by the near-term profit pressure from tariffs. That K-shape playing out in investor sentiment, too.
Yearly captures the complexity.
Yeah, a lot for investors to chew on.
All right, and now it's time for our This Is Not Financial Advice segment. Just a reminder, this is purely a thought experiment, something to spark discussion, definitely not a recommendation.
Purely for entertainment and critical thinking. So, thinking about the new CEO, Kirk Tanner, coming in from PepsiCo and Wendy's.
Yeah.
And Hershey already talking about portfolio pruning and doing these bolt-on snacks deals like Dots, Lily's, and now Lesser Evil.
Okay, I see where you might be going.
We cooked up an idea that really plays on the potential for a big strategic shakeup under new leadership.
All right, let's hear it. The outrageous but plausible trade idea is
a long straddle on Hershey's stock, maybe with options expiring in early 2026.
Okay, a long straddle. So betting on a big move, either up or down, betting on volatility itself.
Exactly. Now, the outrageous part is the why. This isn't just a bet on general market movement. It's a bet on the magnitude of Tanner's strategic shift. Meaning, what if Tanner comes in and gets really aggressive? Maybe he sells off some older, slower-growing brands much faster than expected. And simultaneously, he uses that capital, maybe takes on some debt, to make a much larger acquisition in the trendy, better-for-you snack space. Maybe even buys a whole public company.
Whoa, okay. That would be a major shakeup.
Right. That kind of bold move would almost certainly cause a massive initial stock reaction. Could be hugely positive if the market loves the vision, or sharply negative if they worry about disruption or debt.
And then a big re-rating either way as the market digests it.
That's the idea. It's a bet on truly transformational change,
Yeah.
creating extreme volatility.
Okay, that's the outrageous part. What makes it plausible?
Well, first, the earnings call itself mentioned Tanner and potential strategic moves. Second, the company's already doing portfolio pruning and M&A. Just maybe Tanner accelerates it dramatically.
Probably building on an existing trend.
Exactly. Third, everyone's talking about 2025 being a trough year for Hershey and 2026 being a rebound. The market is kind of expecting a turning point, and a new CEO is the perfect catalyst to make that turn sharper, faster. And finally, you still have that wild card of the cocoa tariff situation. Whether those get lifted or not could add another big layer of upside or downside surprise. It just feels like a confluence of factors setting up potential fireworks.
A lot of moving parts, high stakes. I can see the potential for volatility there. Plausible indeed.
It's definitely something to think about anyway.
Okay, so let's wrap up our deep dive into Hershey's Q2. It really was a nuanced picture, wasn't it?
Absolutely. Strong adjusted EPS and revenue beats. Great performance in North America, especially confection and salty snacks.
But weighed down significantly by those headwinds, high cocoa prices and tariffs, creating that distinct candy bar K-shaped performance.
And the company's response is clear. Aggressive pricing, pushing hard on cost savings through automation.
And that really important leadership transition with Kirk Tanner coming in, which could signal new strategic directions.
Yeah, the key for them going forward is going to be that balancing act. Can they pass through these higher costs with pricing without killing consumer demand, especially heading into Halloween and the holidays?
That's the crucial question. So things you'll definitely want to keep a close eye on, that cocoa tariff situation, any early signals from the new CEO on strategy.
And how consumers react to those higher prices in the coming months. That pricing elasticity is key.
Those factors will really determine if that K-shape starts to resolve itself or maybe even gets deeper heading into 2026.
As always, please remember this discussion was purely for informational purposes. It is absolutely not financial advice.
Do your own research, make your own decisions. Your due diligence is paramount.
Couldn't agree more.
Well, thank you for tuning in to Talk Tickers today. We always appreciate you listening and encourage you to share your own thoughts on this Hershey call. What factors do you think will be most important for them going forward? Let us know what you'll be watching next.